Welcome all to the Node, brought to you by DeFi University and myself. Let's bring David up on stage. He's always very punctual. He shows up right as the show starts. How's it going, man?
I'm doing great, Mike. I spent the morning building out that OpenClaw agent, and
Oh,
dude, I'm getting that set up on Google Cloud, and so that is going to be our slave.
Mr. Slave. Okay. All right. So, what we're going to jump into real quick is let's just go ahead and bring this up. So, if you aren't already, you need to come over to YouTube, and yes, you need to follow us on the Node channel. So it's at the Node_channel. It's where you can find all of our show times, all of our past streams. You can find, this show, the Node, 2 hours of news and education. We got Crypto and Chill tonight, and on Fridays, me and Jeff just relax, have a drink, talk about life, talk about the markets. It's in the evenings after all the markets close. You have David that does the market wrap up. I need to add it, I do believe. Basically, DeFi University daily market wrap up. He does like a quick 30 minutes at the end of the day, just talking about what happened in the markets. We got the blockchain report Monday, Wednesday, and Thursday at 11:30 in the morning, right after DeFi High. And then, of course, Monday through Friday, we got DeFi High at 11 a.m. Immediately after this, we're going to see if the live redirect actually works today. And then we got Saturday nights. We have Jeff, who is a DJ. He does a bunch of music. Great way to just kind of chill out, chat with people and listen to some good music. Thursdays, we got the Red Pill, where we have a panel of about 4, 5, 6 people, and we just have drinks, and wherever the conversation goes is wherever the conversation goes. Very, very spicy. And then a couple of people from our community started a channel with us called Gaming and Chill, Jay and Ellie. They're going to be starting to stream this weekend. They're going to start streaming Arc Raiders and just Web3 games, crypto-based blockchain games, things like that, and just kind of maybe even get to a point to doing some interviews, things like that. So a ton of content here. We're trying to become a network and just bring you good quality, no hype content. We're not going to do clickbait. We're not going to do anything like that to try to get you to to come and watch. We just have good quality, verified, news and education.
We also don't get paid to do this. So please have some more soup, sir. Please, sir.
Yeah. The least you can do is follow us. Follow and share the stream. That's all we ask. We don't charge for our Discord. We don't charge for for any of our shows. It's anything we charge for, it's an extra. If you want to buy hats or shirts, if you want to one-on-one mentorship with David, if you want to be on the live calls, the daily live calls, DeFi High is all unpaid. I can't say the F word. It's all unpaid. David is
cash flow negative.
Cash flow negative. There you
That's
go.
Right.
If you want to follow us over here, let me actually pull up the node real quick. Is our X channel, and that's where you can find some some good information. That is at the Node channel, no underscore. And then this is our website that David's been hard at work on. It's the node.pro. And so all of the news that we're about to go over, I've already posted, before we go live, I posted all the articles. So we're not just giving you the news. I'm giving you the sources so that if we don't go in depth enough for you, you're more than welcome to click on the link. You can read to your heart's content. You can go deeper if you want. Some people like to go deep. It's some of us can't go deep. So
it's a shame. That's such a shame, Mike. I'm sorry, man.
So that's one of the features here on the page. You can get to DeFi University, all of those courses that you don't have to pay anything for. Is here at DeFi University, and the courses that DeFi Don is going over next in DeFi High. All of it is there. You can watch us live. The chats here, community. You can join the Discord. join the live calls, the live video calls, 3 separate 1 hour calls a day that you can be with David and the rest of his community, where they talk about strategies that they're doing, what's working for them, what's not. Great mentorship, the one-on-one coaching, our automated newsletter that I am super, super excited about. As soon as this is ready, we're going to be pushing everybody from our old newsletter to this one. $20 a month. Nobody out there that I've found has anything like this. And I'm not just saying that. It's fully automated. And you can pick your assets. So like I picked Bitcoin, ETH, Sol, Arrow, Canton, stocks. So Coinbase's stock, gold, silver, and it automatically adds the S&P, Nasdaq, and the Dixie, the dollar. So you can add whatever asset you want, and it will generate the newsletter for your asset. So you get trading ranges, you get liquidity pool ranges, lines of support and resistance. You get all the news that is tailor made for the assets you are interested in. So it isn't something that I pick what we're going to cover. It's you pick what you want. You can generate this at any time, wherever you are in the world, wherever your morning is, wherever your evening is, wherever your afternoon is. You can pull it whenever you want. And it's, I believe you said like 5 or 10 minutes is kind of the data when it regenerates.
Yeah. So what I'm doing right now, Mike, is just working to make sure that that tool, that paid newsletter,
Yeah.
that all of the data is up to date as much as it possibly can be. Right
Yeah.
now, it is not.
Okay.
Mhm.
So that's what we're working on. We haven't started pushing this yet. If you want, you can start looking at signing up for it, but hold off until we give the go ahead. These are just some of the tools that we're working on. So there is a bunch of other tools that David's going to be adding to the site once they're ready. And so there's an option strategies.
So, Mike, if you scroll down through that a little bit, that is actually just if you keep just scrolling down through this. So, this is actually some of the best options education out there, man, because this sums up 20 years of options education and research into one single page web application. So I, originally got involved in markets in 2010 with gold and silver in that first run up into 2011. And then in 2011 and 2012, I was introduced by a business partner of mine to Tom Sosnoff and Tony Batista over at they're the guys who created Thinkorswim, and then they went and created Tasty Trade. And so when I got introduced to the guys over at Tasty Trade, man, immediately I fell in love with options. And that was, 15 years ago. So I've been doing this for a little while now. And this single page web application, bro, this thing is
Yeah,
basically everything that I learned from Tom and Tony. Well, the majority of it just summed up into one website. So
yeah.
it's incredible. Yeah.
All right, and then we have this the DeFi flight simulator. So this is where you can build out what DeFi positions that you're in, give all the information, and it will. Well, actually, you know what, David, you go ahead and explain
Oh,
this.
yeah. So,
You know how to
when you're
build.
working, yeah. So when you're working in DeFi, sometimes, when you're operating and putting positions on, let's say you've got a lend borrow position, maybe you've got a concentrated liquidity position, maybe you've got a full range liquidity position that you've got on, maybe you're staking some assets somewhere. You could also be just single lending, USDC or USDT. Maybe you've got some rebasing yield bearing stablecoin that, like SUSDE that earns like a rebasing yield or a native yield. Or maybe you've got LSTs or LRTs, liquid staking tokens or liquid restaking tokens. All of these are yield bearing assets. And it can be really difficult to like track your blended like APY
Yeah,
across a portfolio. And so that's what I built this tool for. You can throw all your positions up into this, and then over on the right hand side there, Mike, where it says weighted average APY. Yep.
yeah,
So you'll be able to track the weighted average of your portfolio. Like how much yield are you actually generating across your entire portfolio? So, yep, that's what I built this for. And I also built in a bunch of custom protocols into this. I originally built it to be like a bond ladder. I wanted to build a bond ladder in Pendle. I ended up
Mhm.
building that. I just wanted to be able to do like 20% APY and just prove to the community, in DeFi University that, hey, you know what, over 90 days, we can do 20% in Pendle. And so I built this tool so that I could track the weighted APY. And then I deployed into the real portfolio. And I actually just closed those positions earlier. I think it must have been on Friday.
Well, and I can't stress the importance of that is, simply investing in these assets and investing in these strategies and in DeFi, you can't just blindly do it. You need to track your positions. You need to track what you're actually making, after it's all said and done, after the dust settles, after impermanent loss and, after, everything shifts and, APYs, a lot of them aren't fixed. A lot of them shift. If you're doing looping strategies to where you're almost doing like an arbitrage between borrowing and lending, if those APYs shift, if what you're paying to take out a loan is ends up moving against you, and you're not out earning that, then you're losing money. So if you're
Right.
not tracking your positions, then what are you doing? You
Well,
need.
so a tool like this, Mike. So this is actually all manual. So the value of this tool for me is like if I want to build a portfolio before I deploy, just so that I
Yeah.
can see, hey, you know what would the weighted average APY be for these portfolio positions
Oh, no,
before I ever
I get
enter
what you
them? Yeah,
th th
that's what I built this for. This
yeah,
was like a pre-deployment tool. But
yes.
after you enter positions, this is not going to track them in real time.
No,
Uh,
no, I
so
was just adding to that, that you need to track your positions. It's like, it's good to do your due diligence of, is this gonna be a profitable position to get into? But in addition to, once you're in those positions, you need to track those on a spreadsheet or, using a software of some kind. There's a bunch of them out there. Metrics Finance is one of them. There's a bunch of different, applications out there.
what about that block turtle? That looked kind of
We're
interesting.
actually gonna be talking to him on what, Friday? Is
I
we're gonna
think
be.
so. Yeah,
So,
yeah.
yeah, no, Block Turtle's another one. There's a bunch of them out there, and I highly suggest, and, we're not paid by any of them. I just want to stress that you need to do your own research on these different tools. You need to find the one that works for you. So, I don't want anybody to feel like we're pushing any, individual one.
No, I
So,
mean, don't get paid from any of these. So
no.
this is just what we use.
Absolutely. And then last but not least, there's the Trader's Bible. You wanna,
Oh
kinda
yeah, this
fill us
is
in on
cool.
this?
Yeah, so I built this because I trade on GMX. I've got positions on GMX, and I've
Mm,
been trading on GMX for years now. I really like that pool model. So when you're trading on these different perpetual futures, decentralized exchanges, many of them have completely different architectures, and so a different type of architecture means a lot when it comes to the funding and your execution
mhm,
on a trade. And so I like trading against a pool, and GMX has a really great API. So there's a couple of things that I wanted to be able to build out, not just for myself, but for everyone in the DeFi University school community. Was I wanted us all to be able to, Mike, if you go to where it says education, you see there in that left hand tab, education. So
ah,
let's see here, because yeah, perfect. Okay, so here, let me just go ahead and open this up on my end. So on the that left hand panel there, so it says dashboard, pyramid, stops, tracker, free roll, survive, risk, and education. So you're in the education tab right now,
mhm,
and I built this to help educate everyone in the community on how to, number one, how to pyramid in to positions, because
mhm,
everyone likes in crypto, everyone likes to talk about, well, we need to DCA in.
yeah.
That is exactly the opposite of what professional traders do. Like you don't add to a loser. Okay.
Yeah,
That's, you just don't do that. So what you do is you pyramid into winners based on R. Okay, so R is a risk unit. When you really start trading and you do this for a living, you can't think of it in terms of dollars. That's not going to work for you because it'll fuck up your mindset. If you think to yourself, oh well, I've got $1 million of risk on, and today I just made $100,000 in a day, 10% on your portfolio, that's going to really mess up your mind.
Yeah.
Or maybe in a day you lost $100,000. I've had that happen. It's horrible. So it's like that'll mess with your mind. The way that you've got to think about it is in terms of R. Okay, so you've got R, Métis, you've got risk units. You turn
Yeah.
everything into a risk unit, and that way it changes the way that your brain thinks about it. Becomes a lot easier to remove emotion. If you're
Yeah.
thinking about stuff in terms of R and not in terms of the dollar, well, then you'll make a hell of a lot better decisions when you're thinking in terms of R. So pyramiding is one thing, and then setting stops, so stop loss mechanisms. But
Mhm.
the way that you set those stops, you got to do that programmatically. So you can do that based on a chandelier. You can do it based on ATR, average true range. And so I put a ton of education into this.
So I'm gonna jump in here. All these terms that he's using, don't worry about it. Half of them I have no idea what he's talking about either. That's why he built DeFi University. Is go over to it. It doesn't cost anything. There's no catch. Go to DeFi University. Go to the Node.pro. Go to education. Go through the course. You'll learn all this stuff that he's talking about, and you'll be able to decrypt. Whenever David speaks, the AI
I
that
know.
DeFi Don built. David isn't a human. He's an AI that DeFi Don built.
You know what it is, Mike? It's the language. It's the language and the
It
jargon.
is.
Yeah,
Dude, it's the same thing
yeah,
as like when me and my military buddies are together and we're using a bunch of acronyms and a bunch of stuff that it's just a language that you need to learn. But
it is.
you need to learn it if you genuinely want to make money in these markets in TradFi, DeFi, whatever. You need to understand the jargon. You need to understand what successful people do to be successful. Kind of the code that I've cracked in life is whatever I want to learn, whatever success that I want to have personally, I find somebody who's achieved that and I align myself with them and do whatever I have to do to learn from them. Because they've already made all the mistakes. They've navigated those rough waters. I want somebody that's already plotted the course that I can just learn from. So that's the life hack. Don't beat your head against the wall trying to figure this stuff out on your own when there's a free freaking course that you can go through and learn it.
Yeah, yeah, and so like the rest of the things in the education hub about, setting exits and how to exit, because most people fuck up the exit pretty bad. Like, it's easy to do all the research and then, have some conviction and enter a position. And then for that position to go your way, okay, great, you're making some money now. When do you exit? How do you exit? Like, are the different ways in which you can exit? So, I put a bunch of information in there about exiting, about sizing the position in the first place, about how to manage risk. A lot of great information in there about risk management. And then there's also a lot of behavioral stuff too, because there are all these psychological biases and fallacies that we fall victim to, even when you know about them. Your brain still falls victim to them. So just monitoring for that, super important. So this is just basically I modeled it after Bloomberg. So like
Yeah.
it's a Bloomberg terminal type tool. So yeah, pretty cool.
So you can see here on the Node.pro, DeFi University, you can either hit courses or you can hit DeFi University, and you're going to find that. Now we're about to jump into the news. We're going to transition over to that, but over here on the left, you'll see these links, the research links. I'm going to basically I posted these so the further down is where you want to start and work your way up if you're wanting to go through these news articles, because some of them I'm going to pull up, some of them I won't. Again, we don't have time to go in depth on all of them, so I'm just going to breeze over them. But if you hear me talking about something that you want to go deeper on, that's where you're going to find the link. So I like to point that out. So jumping right into it. All right. So it looks like, and David, I want you to confirm this. It looks like there was a Bitcoin squeeze. It surged to 75,253 today, fueled by a massive short squeeze that saw over 609 million in total market liquidations, roughly 486 million from shorts. Analysis note it is testing the 75K resistance level. What do you see?
Yeah. Yeah, no kidding. So I definitely do see a breakout in progress. So I can share this just really quick, Mike,
Absolutely.
before we hop on over to anything else. So this is BTC. I've got only two levels marked on this chart here. The important level for me is what was broken just yesterday, 74 and a half. So that $74,500 level, that was an important level of support. So if I just go ahead and grab an arrow tool real quick, I want to show everyone this. So this was an important level of support back at last April during the tariff tantrum lows. I think that was like April 7th. That was 74 and a half K held as important support. And when that level broke, it became resistance. Notice on the retest here, just a couple of weeks ago, earlier this month, got rejected at resistance. And then we got a breakout. So the breakout that we got just yesterday on the back of that short squeeze and some levered short positions getting liquidated sounds like, about a little bit more than $500 million of leverage liquidated yesterday. So that short squeeze pushed prices higher. We got the breakout and we're just hovering right around 74 and a half. So a continued push higher. Where is the next level of resistance? Well, probably comes in right here at 81, 80,700, 81K or so. That looks to me like the next level that Bitcoin might test on the upside. Oh, Mike, looks like
Let's do
lost you
this.
there. Yeah.
No, I'm just being messing around with the sticks a little bit. Just I want to make sure that people can see the content the best possible. All right. So next up, we got Citigroup price target cut. Despite the rally, Citigroup
They are
lowered.
silly, dude.
Yeah, right.
Yeah.
That was a Freudian slip. Lowered its 12-month BTC target to 112,000 from 143,000, and ETH to 3,175 from 4,304, citing citing stalled U.S. crypto legislation and narrowing window for regulatory catalyst. So what they're talking about when it comes to the regulatory stalling is the Clarity Act, and it's been stalled by the majority, the Democrats. And me and David have talked about this, and somebody in the chat actually brought it up, where and it was very insightful that we are in the midterms, and if they can stall this Clarity Act, that is going to establish a lot of the rules and the guardrails of how regulatory bodies regulate crypto, DeFi, things like that, stable coins, us being able to earn yield, things like that. Then potentially, if they can flip some seats in the House and the Senate, in Congress, then they can basically make it more appealing to banks. And if you don't understand government, I'll give you just a quick summary. Politicians pander to us during elections. They tell us everything we want to hear, both right and left, Democrat, Republican, blue and red. As soon as the elections are over, they go back to serving those who they actually serve. And this isn't all of them, but it's like 90-95% of them. And that's all it takes. And there's lobbyists and special interest groups in Washington, and they have endless deep pockets. And a lot of people that work for these lobby groups and these special interests used to be politicians. That's the jobs that they get. That's one way that they don't bribe, they bribe, but don't bribe people, is offer them, high paying jobs after they leave office if they do their bidding. It's They make the laws, they know the loopholes, they know how to make themselves richer and more powerful, and those that keep them in power and keep them rich and powerful. They are working for the banks. The banks don't want us to earn on stablecoins because it destroys their whole model of how they profit. David, what are your thoughts?
Yeah, well, I mean, I think Citigroup is right to downgrade Bitcoin and to downgrade ETH for this
Oh,
year. It's kind of amazing that a bank actually did that, because when you take a look at some of the other price targets from other banks, they're like completely insane. Like they're talking about like $250,000 Bitcoin this year.
yeah.
Um, so I just don't see how in the world that's possible. Bitcoin, for whatever reason, has a cycle that it follows. And that cycle says that right now in March, we get a bear market rally. And then that rally peters out throughout the rest of the spring because we're in a Bitcoin bear market. So I'm just, happy to see that Citigroup actually downgraded these assets a little bit. Um, I mean, I agree with that. I think that their target on ETH this year is probably a little bit too high. But ETH right now is outperforming Bitcoin. ETH is
Yeah.
outperforming most other alts. It's actually doing really, really well. So
It's just shy about 2,400.
yeah, 23 and change, I think.
Yeah.
2335. Yeah, but if you take a look at ETH BTC though, ETH has been outperforming Bitcoin for the last couple of days.
Not Scoop Boy. Did you guys see Mastercard bought a stablecoin company? You should have been watching the show yesterday, man. We talked about it. Um, let's see. All right. So DeFi, Mantle and Aave integration. Mantle Vault has officially bridged 1.25 billion in DeFi depth to Bybit's 80 million users through a partnership with Aave and Cyan, signaling a major CDFI, centralized, decentralized finance. This is what we've been talking about for over a year now. Is the retarded fish frog baby of traditional finance and decentralized finance. They're coming together. How that's going to look, what mutation that's going to be, we don't know yet, and a lot of it has to do with the regulation I was just talking about. These regulatory bodies, and mostly the U.S. and European countries, because they're the market share of the world economy. Most other countries follow the lead of the U.S. and a lot of the European countries. But however that ends up coming to be, whatever that framework looks like, is going to be a major part of what this decentralized, centralized, modernization of the traditional finance system is going to look like, because it's happening. You can look at the data. You can go to rwa.xyz, see the tokenization of real world assets. You can look at DeFi all through this bear market. They haven't skipped a beat. It's pretty much
So
up and to the right.
so Mike, what did you say about Mantle partnered with who? Because I brought up if you want to bring up my screen share, I've got
Ovid.
deep yeah, I've got DeFi Llama. I've got DeFi Llama up. We're just taking a look at the Mantle chain. And this is super interesting. TVL on Mantle has gone straight up over the last, looks like, from what is that, the middle of February to today. It's gone from 260 million TVL to 766 million TVL. So tripled in, what is that, like a month or so, basically a month. That's amazing. So where is that coming from? You said it was a partnership with Bybit and Cyan?
Mantle and Ave.
Aave.
Yeah.
Aave.
And then it looks like well, I'll read it again real quick. Mantle Vault has officially bridged 1.25 billion in DeFi depth to Bybit's 80 million users through a partnership with Aave and Cyan.
Got it. Okay, so now I understand. Okay, so it sounds like Bybit has a bunch of users, of course, right? And maybe they partnered with Aave, like as a vault provider for, I want to assume, maybe some type of money market product that Bybit offers. And it sounds like they've bridged that over to the Mantle chain. That's what it sounds like. If I'm taking a look over here at Aave, what I want to do next is I want to take a look. Oh, look at that. The
See,
Mantle chain has gone straight up the list.
yeah, see, I guess there's a mantle vault on Aave, is what I'm guessing.
Yeah, that's what I see. So, I can see the supply position over here in this Mantle vault has, increased significantly. Last time I checked in on this, it was a much, much smaller market. And also, you've got the core mainnet market at the very top of the list. Then you've got the prime institutional market. Then you've got Plasma. Plasma is still a really big market on Aave. And then Base and Arbitrum. These are the two. Well, Plasma is also a layer two, I guess you could say. It's more like an EVM compatible layer one, but you could think of it as a layer two, kind of sort of. Base and Arbitrum layer twos, Mantle also a layer two. So these are the chains with the majority of the liquidity now over on Aave. Yeah. So if I'm just taking a look at this USDT zero market over here on Aave, on the Mantle chain, I just want to click into details. And I'm most interested to see, what does the kink look like? Okay, great. So that's this part down here. The,
That's a whole different show.
the interest rate model.
Financial kink.
I
That's
know,
a
I'm talking about kinks over here, man.
whole new kink.
So yeah, man, really interesting to see that. It's just great to see that, these chains are starting to become a little bit more mature, and these markets are becoming a little bit more mature. You got 1.3 billion on Mantle, 1.3 billion on Arbitrum, you got 1.3 billion on Base. If you take a look at Plasma, 3.7 billion on Plasma. I actually just exited all of my Plasma positions last week, simply because if we hop on over here to DeFi Llama one more time and then take a look at the Plasma chain, look at what's happened to TVL on Plasma.
Yeah,
It's gone straight down.
yeah.
So really interesting to see that, if I'm looking on DeFi Llama, it's telling me that the TVL on Plasma is 896 million, but on Aave. But if I hop on over here to Aave, Aave is saying that the entire market is 3.74 billion. So which one's telling me the truth? You know, or am I interpreting this information incorrectly? DeFi Llama tells me that the size of the market on Aave on Plasma is, if we just show that one more time, DeFi Llama is telling me 896 million in TVL
Mhm.
on Plasma, and it's also showing me that the entire Plasma chain is worth 1.13 billion right now in TVL. And look at
Well,
how that TVL has just
is
collapsed.
one including stable coins and one not?
I think it includes everything. But if I hop on over
I'm just,
here,
I'm just asking. I
I
mean,
think I think it does. Yeah, I think it includes everything. And so, but then when I hop on over here to Aave, Aave is telling me total market size 3.74 billion, total borrows 1.74 billion. So that means the total available is 2 billion.
mhm.
Maybe DeFi Llama isn't pulling this in properly. I don't know.
Yeah, like I said, I mean, I would definitely love to get to the bottom of that because it's something that we could teach the community.
Sure. Yeah. I mean, is DeFi Llama's data valid? Is
Well,
it?
and we need to figure that out because if it's not, we need to stop using it as a reference.
Or is Aave lying to us? What do you think?
I, honestly, I would tend to lean towards the protocol not being 100% transparent over DeFi Llama because DeFi Llama, their whole business model is accuracy, accuracy of data. Whereas Aave is all about attracting liquidity, and not to say that they're trying to be misleading or anything like that, but potentially, they're looking to draw liquidity in, and so they want to paint the best picture possible. Whereas DeFi Llama, their whole business model falls apart if they're not accurate.
I don't know. When I take a look at these markets, if Aave were lying, about the size of these markets
Mm.
or about the capacity or how much liquidity is in each market, uh, they would never be able to get away with that. So it must be that the way that data is being reported over here on DeFi Llama is just, it's got to be incorrect.
I, I
Because,
I would lean towards not making assumptions. Like we really need to dig into it and and find the facts.
yeah, well, I mean, I'm looking at it right now. Like DeFi Llama is telling me that on Aave, on Plasma, the
Yeah.
TVL is 896 million, but Aave is telling me something double that. So I don't know which one's which one's correct.
Like I
Huh.
said, I really think that we need to do a deep dive on this and
Yeah.
find out which one's accurate because yeah I don't want to say either way. Because I mean we're just making assumptions and I don't want to be that channel that it's the same thing as doing like price predictions where people are like oh this token is going to go to this astronomical number. It's like okay based on what your personal feelings. It's we need to make sure that we're putting out good solid information.
Yeah, maybe there's just something not included in this. That I
And,
guess.
and that's kind of like what I was kind of alluding to with when I asked, is it not including stable coins or something like that? Because I know Plasma has quite a bit of stable coins on it.
Yes, Plasma is a stablecoin chain, and DeFi Llama is showing me the stablecoin market cap on Plasma, 1.5 billion. It's just so strange that you know because when I hop on over here just to Aave, just
Oh,
the USDT market on Aave says it's
what was
1.7.
what was Ave saying that the Plasma chain total was?
Yeah, total available 2 billion and the
Okay,
total
cool.
market
Then
3.7.
now go back to DeFi Llama and add the stablecoin market cap to what it's reporting is on chain because that should add up to like around 2 billion.
Mm-mm, no.
Well, you said that
Yeah.
stable was 1 point something billion and it was reporting 800 million.
Yeah, so it says here stablecoin market cap
Yeah.
on DeFi Llama. It says on Plasma,
Yeah.
stablecoin market cap 1.52 billion. And
Okay.
then it says total value locked in DeFi 1.13 billion. So there's the stablecoin market cap. Um, but yeah, I must be misinterpreting something here because I don't see why it's showing me 896 million for
Well,
TVL.
let's go ahead and I don't want to get bogged down on this.
Yeah, we
Let's
can
go
move
ahead.
on to something else.
Let's me and you jump on like sometime later today and let's really dive into this and we'll talk about it tomorrow.
Cool. All good.
Yeah, because I mean it's super important because if you can't rely on the data, then
I
what's the
think
point?
I think Mike, what must be going on is that I must just be misinterpreting what this number means.
Uh,
It must be my own user error. It's got to be.
well, but the thing is I'm making the same error, so we need to figure out so we can educate people on how to how to interpret this data properly.
Yeah,
Because because I mean, I would just glance at this and I would just look at that number and be like, oh, okay, that's what it is. We need to
me
understand
too.
how it piles this data, like the different data points that it looks like, looks at to get that number. So, all right, let's pop over to the next one. Orb's agentic layer. Orbs launched a dedicated execution layer for AI agents and DeFi, providing secure, verifiable on chain trading infrastructure. I have never heard of Orbs. Have you?
I've never heard of Orbs either. Yeah, so Orbs dedicated infrastructure. Huh.
For
All right.
AI agents? Is that like an X402? Well, here, let me pull up the source.
Orbs, dedicated infrastructure for AI agents. See, we're seeing all of these new pieces of dedicated infrastructure just for agents. So it's called the Orbs Agentic Layer 3 execution layer, supporting autonomous AI agents in the DeFi ecosystem. So they're calling it like a decentralized backend that bridges the gap between like an AI agent strategy and the actual execution of that strategy on the blockchain. So this looks actually really, really interesting, Mike.
So,
Really interesting.
so it says the platform enables agents to perform structured actions such as swaps, limit orders, and time-weighted average price strategies through dedicated execution tools. These include AutoSwap and exec swap for swaps, auto limit for limit orders, and additional safety focused flows, rather than relying solely on agent side logic. Execution parameters are submitted through Orb's infrastructure for independent verification. Can you decipher that for us?
Yeah. So here, what I want to do is walk through how to use this. So basically, these orbs are, you could think of them like a layer three. It's, the orb is like the brain or the LLM, and it's the trust, but it acts as the trusted hands that carry out those financial actions on chain. So here's like an architectural flow. You don't host your AI agent on orbs. Instead, your agent, like whatever is running on your server, your cloud server, like Amazon Web Services or maybe Google Cloud, it interacts with orbs to execute those transactions safely. So here's an example. You've got your AI agent running on your Google Cloud or your AWS, or it's running locally on your local machine, and you decide on a strategy. You want to maybe buy $1,000 of ETH if the price of ETH drops by 5%.
Yeah.
That's your strategy, right? Okay. So then you've got the orbs execution layer. It's going to receive the instructions to do that and check against these they're called co-signed Oracle guardrails. So it's going to say, hey, it's going to look on chain and say, hey, is the price actually down 5%? And is slippage under whatever my tolerance is? Let's say 0.5%. If yes, then it's going to execute the transaction. Orbs will trigger the transaction on a layer one, like Ethereum, or a layer two, like Arbitrum or Base. So that's the architecture flow. And implementing this, it seems like it's actually pretty straightforward. Um, so it looks like you could actually, use, they call it Orbs Lambda. So you can set Lambda or like a cron timer. So cron just means by time, to execute your AI agent requests on chain. So it's kind of like bridging, the on chain execution with the hands of an AI agent, which is
Mhm.
pretty cool. Pretty cool. We're talking about like real agentic execution.
Nice. Nice. All right. Next up, we got a Stacks upgrade. Those that aren't familiar, Stacks is a Bitcoin project. The Stacks protocol, SIP-034, went live, increasing the network's capacity for Bitcoin DeFi applications by up to 30x, allowing for more efficient native Bitcoin yield strategies. I know you're very up to speed, and you and DeFi Don are very up to speed on this because you guys are building out a lot of stuff on Bitcoin mainnet. So, do you want to decipher this for us?
Yeah, so they call it the Nakamoto release. And so they're trying to turn Stacks from like basically kind of a crappy Bitcoin sidechain into more of a true Bitcoin layer two. I guess you could think of like more similar to something like Lightning, but I don't think that it's quite there yet. So here's the problem that they're trying to solve. This upgrade, they're trying to solve this bottleneck problem where Stacks was limited by Bitcoin's really, slow block times, 10-minute block times. So what they did is after the upgrade, now they've got 5-second blocks.
Mm,
Um, and, it seems to me like they're trying to get this stuff to settle on top of Bitcoin,
mm.
a little bit more like Lightning can.
Yeah.
That's what it looks like. But, I still am not comfortable with their SBTC. It says here that the Nakamoto upgrade was the prerequisite for SBTC. So SBTC is like their Bitcoin backed asset, but I don't want a Bitcoin backed asset. You
Yeah,
know, I don't want,
you want native Bitcoin.
yeah, I want native Bitcoin. I don't want fake Bitcoin. You know,
Yeah.
uh, like, so yeah, I mean, hey, it's great that they upgraded the thing. Um, and it's great that I'm sure it's faster now and, you know, that they've got more capacity. So that's really, really cool. But I still don't want SBTC. I don't care what type of signers they have for it. I don't care if the governance is very decentralized. None of that matters to me. What matters is that it's not true BTC.
Yeah.
So, and they had a really big hack on that DEX. I think it was called the Alex DEX, where basically like some developers just ran off with like a tens of millions of dollars. Like that's basically
Oh,
what happened. I think that they were able to get a lot of that money back, but yeah, really bad look, really bad look. And I think that there are probably better solutions out there, like building on top of Lightning, for example.
well, I mean, that's why I'm so big on non-custodial, using non-custodial DeFi platforms and protocols is just because of that. It's anything custodial. Any platforms. I don't care if it's centralized or decentralized. If it's custodial, not your keys, not your crypto.
It's
It.
very true. It's very true. You know, so it's kind of challenging to operate non-custodially on Lightning
Mm,
because you need to be able to open these channels. So that
gotcha.
basically means that you've got to run your own node infrastructure in order
Mm.
to be really non-custodial. But I'll tell you, Mike, you run your own nodes and you manage your own channels and you own your BTC. That's true sovereignty, man. That's
Well,
true sovereignty.
we are the node, so
That's right.
we are decentralized. We don't play in the system. That's why we're able to do the news objectively, and be able to just tell the truth and not have to worry about the getting censored or getting shadow banned or anything like that. So yeah, that's why we're here. We're here to be that that channel of integrity that's just going to report the news as it is. We're going to
Yeah.
fact check,
Well,
make sure that
no,
we're not hyping things, and so.
well, nothing to lose, Mike. You know, we got all this negative cash flow over here. So
Oh
it's,
yeah,
you
oh,
know, like
it's all about losing money. It's step one, make a channel. Step two, step three, lose money.
I know,
It's our
basically
business model. That's our business.
that's basically how it's going. We're 2 weeks in, but that's basically how it's going.
Dude, I'm not even worried about it because I see what we're building, and I know that that this is going to be profitable and very successful and profitable for our viewers. So, with the tools that that we're offering, where we're not charging anything, and just the resources and the information, and just everything that that we're pretty much giving away. Yeah, we're going to have a couple of things that to help keep the lights on that we do charge for, but you can opt into those. There, you don't need those to be successful. That's just things that are going to take you to the next level. It's going to make you more successful. So that's how we're
Yeah,
building. That's how we're building
yeah.
this.
You know, I'm just thinking I would really like for this to, you know, over the next couple of weeks, just pay for itself. That way, you know, that would be nice. But so Mike, did you see that piece of news about Ethereum? The Ethereum Foundation released a new 38-page manifesto.
No.
Yeah. So tell me. So this is kind of interesting. So I want Google to tell me more about this. So I was just you know just reading
More?
about this. Tell me
Starship
more.
Starship
Yeah.
Trooper. You want to know more?
So they call it the EF mandate. It was released March 13th, and
Okay,
this
so what
Ethereum.
about like 4 days ago?
Yeah, so that's about 4 days ago. So it says the debate surrounding the EF mandate. So it marks a significant philosophical fork in Ethereum's history. For the last 2 years, the Ethereum Foundation appeared to be corporatizing to compete with faster, more centralized chains. And this new 38-page document effectively kills that trend. So it says the manifesto centers, and I don't know, Mike, if you can find anything, any articles about this. It'd be really cool if we could maybe read like or find a copy of the manifesto.
Yeah,
But
hold on.
it says the manifesto centers on a new acronym called CROPS, and the foundation now views this as the invisible whole of Ethereum's development. If a project or upgrade doesn't satisfy all four, the Ethereum Foundation will likely not fund or support it. You see, this is why I like Bitcoin because it's like much more decentralized. Although, there are political battles within Bitcoin too. So here's what it says about crops: censorship resistance. So ensuring the network remains neutral regardless of political or physical pressure. And then the R is resistance to capture or open source. It says all code must remain open and free, preventing black box proprietary systems. The P is privacy, shifting from transparency by default to giving users total control over their data flow. That's really cool. And then the S is for security, prioritizing long term mathematical resilience over short term performance hacks. So this is a 180-degree pivot because in 2025, the Ethereum Foundation, hired Tomáš Stančák as co executive director to lead Etherealize, which is a business development arm focused on institutional onboarding and RWA tokenization on Ethereum. So Stančák resigned last month, and his replacement, Bastian Awe, what a name, man, along with the new mandate, signals a retreat from the institutional sales model. Okay, so I like that. And Vitalik Buterin has framed this shift as turning Ethereum into more of a sanctuary technology. And he's saying that in an era of AI-driven surveillance and centralized control, that Ethereum's value isn't really being like a faster Visa, but more like becoming a digital bunker that no one, not even the Ethereum Foundation, can control. Man, I love that. That sounds great. So yeah, it's there are people who are arguing against this though. There are critics. And the critics argue that the Ethereum Foundation is ignoring reality, they say. They say that by deprioritizing stablecoins and institutional rails, they risk losing market share to change that to other chains that will actually help people pay rent. And I'm not sure that I agree with that, but there are some really prominent voices who say so, like Dankrad Feist and Mason Nystrom from Pantera and David Hoffman. But there are, others who are, of course, arguing for this new direction for the EF, the Ethereum Foundation. And they're saying that Ethereum's only true moat is its decentralization. And if it tries to become this bank-friendly chain, then it will just be, a worse version of a database. So yeah, what does this mean? There's a couple of upgrades scheduled for Ethereum this year. There's Hegoda, that's for late 2026. And this is going to be like censorship resistance baked into the consensus layer. And then you've got the walkaway test. So the walkaway test is, could the Ethereum Foundation dissolve tomorrow? And would the network be able to evolve autonomously? That is so cool. That is so cool. So you know what that means, right, Mike? Like the walkaway test is, if the Ethereum Foundation vanished tomorrow, could Ethereum and its layer twos, or Ethereum as a chain, could it survive and thrive on its own? That's really, really cool, man. That's really cool. So
Well, this is what I was able to find from DeFi Llama News. So the opposition, it looks like Awa Sunyin, co-founder of blockchain interoperability project Anoma, said that this manifesto is so unhinged. It's not written by an organization that's finally growing up. Quite the opposite. It looks like the organization is stuck in their idealistic adolescence while completely ignoring the reality of what's needed to further the industry. In contrast, Those on the other side of the argument say Ethereum, the blockchain technology in general, should allow itself to be co opted by the industry that it was designed to compete against. The mission is so simple yet so powerful. Make the individual unruggable. Pascal, his last name, an independent Ethereum security researcher said. Not by fucking governments, quote, not by fucking corporations, not by fucking institutions. Principles matter because without them, every system eventually becomes another way to fucking control people, end quote.
I
The
love it.
debate, yeah, the debate between ideology and commercial success is becoming a heated issue as Ethereum faces competition from a cohort of new commercially focused blockchains. They include Tempo, a stablecoin focused blockchain backed by payment giant Stripe, and Canton Network, a blockchain aimed at financial institutions and backed by major banks, including Goldman Sachs, among others. Yet, as traditional finance becomes more and more entangled with the crypto industry, the Ethereum Foundation may be the only organization able to stay true to crypto's founding principles. The Ethereum Foundation currently is the only player with both the resources and network effects to not just keep the cyberpunk dream alive, but also to actually make it happen. That's
So,
the
so who? I'm curious. Who was the person who was like, arguing against?
So that is Sun Awa Sun Yin, AWASUNYIN. It looks like a co-founder of the project Anoma is
So
one.
AWA. So Awa Sunyin.
Yes,
Uh,
Awa Sun Yin.
okay, got it.
How was
Manifesto.
my?
Who is she? I'm assuming that's a female, right?
Yeah, it might. I think it's a guy, but
Okay. Enoma, a privacy preserving, intent centric protocol. Uh, and she recently made headlines for criticizing the Ethereum Foundation. She's the co founder of Enoma, Namada, and Heliax. Okay, she's a researcher and entrepreneur specializing in privacy, zero knowledge proofs, and decentralized architecture. Alrighty. And she's saying idealistic adolescence. All right. So, how does she make money? How does
that's
she make money?
it's important to
That's
understand because that's going to give a lot of motivation.
Yeah, so wealth and income are permanently tied to her roles as a serial founder and foundation executive in the blockchain industry, venture capital, raised 60 million. She oversees a foundation that has raised 60 million. High profile backers include Polychain Capital, Coinbase Ventures, and Electric Capital. Okay, she holds Genesis tokens for companies like Heliax. I'm not quite sure what Heliax is. And she's exited a couple of crypto businesses. Okay, so professional and career. So let's see here. It looks like she has built and exited crypto businesses and is raising money as a VC in crypto right now. So I'm curious, how will the new Ethereum Foundation manifesto impact VCs on Ethereum? What's the likely impact on venture capitalists of this new manifesto? Um, so it's moving from this growth at all costs mindset to more of like a principled stewardship model. So for VCs, it's a double-edged sword, right? It's saying that it provides a stable, long-term, regulatory resistant infrastructure, but it also signals that this Ethereum Foundation is not going to continue to help subsidize the commercial success of specific projects. Okay, maybe we're getting somewhere, right? So if the Ethereum Foundation is saying, hey, we're not going to subsidize your success anymore, if I'm a VC, I'm probably not going to be too happy about that, right? So it says the end of king making. The manifesto explicitly states that the Ethereum Foundation will not act as a kingmaker or a marketing agency. And so in the past, like if you got a shout out as a VC or your project got a shout out from the Ethereum Foundation, that would act as like a de facto seal of approval. That
It's like
other
Elon Musk shouts out Dogecoin or Sheeb or something like that.
right, so now VCs are not going to be able to rely on the Ethereum Foundation to hype or market their portfolio companies. And the Ethereum Foundation is committing to this CROPS framework: censorship resistance, open source, privacy, and security. That's a non-negotiable filter. So if a VC-based project, it doesn't meet those, then it could effectively be deplatformed from Ethereum Foundation research and funding. So that's not good. So let me see. Does this apply to, what was her name again? Awa Sun Yin,
Sun Yin.
or her portfolio companies? I'm just thinking to myself, like, does this like impact her financially, maybe?
Oh yeah, no, I mean that would definitely be a motivator for
Oh, check it out. What do you know, Mike? What do you know? Good old Gemini is saying that Awa Sun Yin's specific criticism of the EF mandate is rooted in the fact that her projects, Anoma and Namada, are direct architectural rivals to the vision laid out by the Ethereum Foundation. So this is what we got here. This is super interesting, man. It's saying that,
keep going.
yeah, it's saying that Awa's core project, Anoma, is not just another app on Ethereum. It's a sovereign blockchain protocol, a layer one, that competes for the same developers and users. So the Ethereum manifesto reinforces an Ethereum-centric world, where the foundation acts as like the moral arbiter, or like of this infinite garden. But Awa is saying that this vision is unhinged because it ignores that the market is moving towards chain agnostic systems. So this Ethereum Foundation is refusing to be a kingmaker. And it means that projects like Anoma, which provide alternative infrastructure, will never receive official Ethereum support or integration priority if they threaten the dominance of Ethereum's own roll-up centric roadmap. So Anoma just got deplatformed by Ethereum. And so Awa,
that's a good reason why she feels that it's unhinged.
Right. And so Awa's going out there and saying, hey, this is some bullshit.
Yeah.
Yeah.
No, well, it's like the drunk guy or the drunk girl that got kicked out of the club. It's like, this is bullshit.
I know. That's basically what happened.
You know who I am.
And so, here's the other one. This privacy part. Okay. So let's see here. Anoma resource machine. So the portfolio win. Okay. So maybe the privacy part could be a win for Awa, though. So if Ethereum developers are forced by the new manifesto to include privacy features, they might be more likely to use Awa's tools like Anoma resource machine or Namada's shielded pool to achieve it, even if the Ethereum Foundation doesn't officially endorse them. Here's why I think that's unlikely. If another developer comes around and builds something that complies with CROPS, and Anoma and Namada don't comply with CROPS. So if a developer comes out and builds something that is a privacy tool that complies with CROPS, well, I think that the Ethereum Foundation might give them, might actually support them over Awa's tools. And so let's see here. What is the impact on her bottom line, right? So it says VCs see Awa's projects as a hedge against Ethereum. If the Ethereum Foundation manifesto's idealistic approach causes Ethereum to lag in user experience, that's what Awa is predicting, then her projects, which focus on these intents, which are kind of like making crypto as easy as Web 2, become an alternative for that same venture capital. So this manifesto is driving a wedge between Awa and people like her, venture capitalists, and people who want a privacy user centric experience on Ethereum. So it's I'm all for it, man. I think that this type of discourse is positive, and being
Long,
able
long,
to, yeah,
long live the crypto punk ethos.
hell yeah, man, hell yeah.
All right. Well, I'm going to play this video real quick, and then we'll move over to our educational portion and see what you got for us today. But tokenized equities are about to completely absorb the traditional market. This is what we've been showing on rwa.xyz for months and months and months. And actually, you know what? I'm just going to bring it up real quick because it's important to back up words with data. So this is rwa.xyz. This is where I go for data when it comes to tokenized real world assets. That's what RWA stands for. And you can see, over time, since 2024, here's the beginning of 2025, it's just gaining momentum. We're currently at 27 billion, but you can see everything that's being tokenized. U.S. Treasury debt, commodities, asset-backed credit, specialty finance, non-U.S. government debt, stocks, corporate credit, diversified credit, real estate, venture capital, private equity, you name it, it's getting tokenized. And it's just picking up steam. While the markets are pulling back, the crypto assets, prices are pulling back. A lot of liquidity is getting sucked out of DeFi markets, things like that. RWAs is doing nothing but growing. So this is where a lot of my focus is personally, and why I'm so bullish on Canton Network. That's been actually outperforming Bitcoin. And not to say again, I'm talking my bags a bit. I'm not saying running out and buy it. Do your own research, but I'm very bullish on it. But that being said, let's go over to back to this. But tokenized equities are about to completely absorb the traditional market. Equities being stocks, tokenized stocks. This is allowing for stocks to be traded. A lot of the regulations is making it to where it's 5 days a week, but 24 hours a day. So, Saturdays and Sundays will still be off, but you'll be able to trade stocks 24 hours a day. And you can do it without having to use a stockbroker or, and it's instant. You can invest, get liquidity in and get liquidity out as quick as you can click buttons. So this is making traditionally illiquid assets more liquid. So anything you want to add to that before we play the video?
Yeah, so there's a bunch of different providers that allow you to, gain exposure to equities on chain, and they're not created equal. They're all kind of different. So on Ondo Global Markets, they use a one-to-one backing model. So for every token that's minted, let's say, Tesla, on-chain Tesla, that would be, one-to-one for a share of actual stock held in custody by a regulated US registered broker dealer. So they're just mirroring their, off-chain model on chain. That's what they're doing.
Yeah.
So they're trying to mirror the total return of the asset. So this includes price movement and dividends, which are reinvested to increase that token's value or quantity. So, these tokens.
Well, like MicroStrategy or Strategy is a good example with their stock.
Yeah. And so you've got over 200 plus tokenized securities that Ondo has, is offering in its catalog. But you've really got to understand how these things are going to settle. I wish that you could trade options against them. But I don't think that it's quite unless you just want to buy and hold. If you just want to buy and hold and you're happy with all the regulation and that's okay, then great. Maybe this is a more convenient way of owning Apple or Microsoft or Nvidia or the spiders or the Qs or whatever. You can do that, sure, if you just want to buy and hold. But if you want to create like complex strategies, using stock and options and futures, well, maybe this isn't the best vehicle yet, just because it doesn't look like it doesn't look like you can trade options on this, not yet anyway. And that's something that I would really need to be able to hedge risk. But just looks great, man. Like tokenized equities, this is definitely the route that things are going to go. This is the future right here. These tokenized equities, tokenized bonds, tokenized real estate, tokenized commodities. Probably tokenized literally everything.
Yeah.
Watches. You know,
No, I mean anything that again, any physical or any asset that you want to make more liquid, real estate, cars, you name it, diamonds, whatever, things that you used to have to, physically, transact. You're not going to have to do that anymore, with the blockchain technology. But
dude, you could probably just like tokenize. You could literally take a shit and then tokenize that thing and then turn it into a coin. And
yeah,
that would go viral, bro. That would go viral.
it's a shit coin.
It's a shit coin.
All right. So here we go.
When we talk about tokenized security, Ian, my dad's listening right now, probably. He has no idea what you're talking about, just none. If you were to explain that to Andrew in plain, simple terms, we mean a security represented by a digital token on a blockchain. What's the benefits of that?
Well, the moment you put a token that represents a traditional financial asset on blockchain rails, you get all the benefit of that new infrastructure. That means that you can move these assets around 24/7, right? Imagine that you could transfer the stocks that you hold right now in your brokerage account immediately to your Coinbase account or to another type of wallet, and they would just arrive instantly. You can, as a result, take better advantage of different margin rates on different platforms. You can freely transfer them globally to someone else as a gift. There's a lot of benefits that you get the moment you tokenize, because then these assets live on crypto rails. It's very
well. He might get into this, but one thing that I think is key is being able to borrow against these assets to access the liquidity without incurring a taxable event for capital gains. That's a huge one.
similar to the benefits that a
Mike, so real quick, there's something that I'm thinking about as he's talking here, because this is a mirror. Okay, all he's doing is minting a token based on real stock that's being held by a broker dealer somewhere.
Yes.
But what if, rather than this approach, you were to have the origination on chain? So have a on chain IPO where you are fully digitally native. You're Web3 native from the gate.
Yeah.
That would be, a completely different architecture, right? So
I wonder if this is going to evolve into that, though.
Yes, it is,
because they're tokenizing existing commodities, and existing equities. But moving forward, what if a lot of these companies, these crypto companies, are working directly with the New York Stock Exchange, this the CFTC, and all these regulatory bodies. What if just whenever new stocks are launched, it is just 100% a tokenized asset?
Right. It's called a native digital security. And so you move away from a secondary market, which is what he's talking about with this like on-chain mirroring, and you move to a primary market, which is origination on-chain, where you've got your new securities. Those digital securities are essentially minted on chain from the start. So that's pretty cool, man. You could definitely create or take your business public on chain. I think that's the future that we're moving towards.
No, absolutely. All right, let's finish this off, and then we'll get into the education portion. And towards the end of that, I'll probably jump on over to the next show, DeFi Hide, and help Don get set up and stuff like that towards the end. So, I might be in and out.
stablecoin gave for cash. Once you tokenize stocks, ETFs, and the like, you get those same benefits. You can send them globally, use them 24/7, list them on crypto exchanges, trade them 24/7. All that stuff's not possible with normal stocks.
All right. So that is that. I'll remove mine. I'll put yours up. And what do you got for us today?
Okay, so I've got a couple of ideas. Since I've been working on Bob and accounting, I thought that it could be interesting to talk about OpenClaw, or since we've gotten this, decent rally out of markets, I thought that it could be fun to talk about options. So I'd be happy to chat through either of those, Mike. What do you want to talk about?
Let's do options, because I know that's been a great money maker for you and something that you really enjoy. So let's talk about that. And I'm going to pull myself off, and I'm going to jump over and just check on Don over there in the next DeFi high that will be transferring over to here in about 45 minutes.
Gotcha. Okay, so all I'm going to do here is, let's see, I think I want to talk about short calls. That's what I talk about. There it is. The naked call. So this is basically you're just writing a call, this strategy here. And I want to start things off just by playing this video content. And then we can move on from the video content to the slide deck. And from the slide deck, I've actually got a bunch of other educational material that we can run through also. Let me go ahead and grab that. I'm going to throw that up onto this same, so this tab here. So this tab is all of that free options education. In fact, I'm just going to put this as a comment in the chat for anyone who wants to play around with this. Phenomenal education here. So I'm going to go ahead and start things off just by playing the video content. And then I want to run through that PDF document. Here we go. Just let me know if you can hear this. If you guys can let me know in the chat if you can hear it. I just want to make sure that you can hear it.
Nope, can't hear it.
Nope, can't hear it. Okay. So let me go ahead and stop that share, and I'm going to go ahead and fix that. So share the screen, and there it is, and share audio is enabled. So Mike, let me know.
Today, we are talking
How
about
about
one
this
of the
time?
most
Awesome.
polarizing strategies in all of options trading, the naked call. So is it a sophisticated tool for pros to generate income, or is it just a financial time bomb in disguise? Well, let's find out. But first, let me ask you a question. What if you could trade with the odds stacked in your favor, day in and day out, just like the casino? Well, that's really the core appeal of selling options, and it's all thanks to a pretty consistent quirk in the market.
That quirk is called volatility risk premium. It's the difference between the implied volatility baked into the options premiums themselves and what the market ends up realizing in terms of volatility. So what you want is volatility for the options to be super high. That's what you want. You want the implied volatility to be as high as possible. There's a couple of different metrics that we use to track that: IV rank, IV percentile. We want implied volatility to be very high because the realized volatility, what actually ends up happening in the market, tends to be consistently lower than what gets implied into those options prices. So that difference between what's implied and what gets realized, as long as what is implied is higher than what is realized, that difference is called your volatility risk premium or variance risk premium. And so that's what we want to be able to capture by writing options. It doesn't have to be just calls. We could sell calls, we could sell puts, we could sell them together, we could sell them at a ratio, we could spread off that risk. It just really depends on, is there enough implied volatility or not?
And that quirk has a name, the variance risk premium, or VRP. The easiest way to think about it is like this. People who buy options are often buying insurance against a huge market move. And just like with car insurance, the price they pay for it, the premium, is almost always a little bit higher than the actual statistical risk.
This is hedging. This is what, when David talks about hedging, this is what he's doing.
I don't hedge. I'm always long. Zero hedge.
Long and strong and down to get the friction on.
Always. No hedges, man.
An option seller, you get to be the insurance company, collecting that overpriced premium. And just how consistent is this? Well, the data shows that implied volatility, which is really just the market's forecast of fear, is higher than the actual real world volatility about 85% of the time. Think about that. That's a massive.
Okay, and so this statistic is based on like 30 years of market research on the S&P. So this is S&P cash index research. And so all this is saying is that, consistently over the last 30 years, volatility has been higher, implied volatility has been higher than realized volatility.
Statistical edge to have on your side. So let's kick things off by really digging into this built-in market edge. Understanding this is absolutely key to understanding why a strategy like the naked call even exists in the first place. Okay, so what you're looking at here is basically the gap between fear and reality. That crazy line on top, that's implied volatility. It's the market's collective anxiety, and on average, it's priced about 4 points higher than it needs to be. The smoother line below, that's what actually happens. Option sellers make their money by living in that gap, basically profiting from the market's tendency to over-prepare for the worst.
So that is your variance risk premium, that difference between the implied vol and the realized vol.
So, if selling that overpriced premium is the name of the game, what's the most direct way to play it? Well, it's time to meet the star of our show, the naked call. It is the purest and, by a long shot, the riskiest way to try and capture this edge. So, what is a naked call? It's actually pretty straightforward. You sell someone the right to buy a stock from you at a specific price, that's the strike price, and for doing that, you get paid cash, the premium, right up front. Your goal, your entire job is for the stock to simply stay below that strike price until the option expires.
Really, so it's a little bit better than that. So, the stock can go up, it can go down, it can move sideways as long as time passes. And at expiration, if you collected $1 for selling a call and the strike was $100, then, at expiration, as long as the price of the stock is, below $99, then you broke even. So you've got plenty of room.
And this table right here, this is where the danger becomes crystal clear. Just look at that maximum loss column. While other strategies like a covered call or a bear call spread have defined manageable risk, the naked call has one word that should give anyone pause: unlimited. If you are wrong and that stock just keeps ripping higher, there is theoretically no ceiling on how much money you can lose.
Right. So this is called undefined risk. Technically it's infinite because a call means if you sell a call, that means that you're short, and a stock or a commodity or whatever can theoretically go up indefinitely. It can, go to infinity, right? So if you are naked short a call, then you have what's referred to as undefined risk. And in order to take that undefined risk, you've got to get paid. And so to get paid to take that undefined risk, you've got to make sure that that implied volatility is very, very high. That makes sure that the premiums that you collect for selling those calls are as high as they can possibly as high as they can possibly be, so that you get compensated well for taking that undefined risk on.
So you're probably asking, with unlimited risk on the table, how in the world does anyone actually manage this trade? Well, you have to learn to fly using your instruments. And in options, that means piloting with the Greeks. These aren't just abstract math concepts. They are the gauges on your risk dashboard.
Right.
Exactly.
And
Think of
so
it like a
these Greeks are extremely important. Okay, so you got delta right here, this triangle. Delta is your rate of change. Okay, so if you've got 10 positive deltas, then for every $1 that stock moves to the upside, you're going to make $10, okay, on your option. So that's your delta. Your delta is your direction. In the center here, you've got your gamma. This little symbol means gamma. Gamma is the second order derivative on top of delta. So gamma is like the speed of your delta. How fast is your delta going to move? And then this gauge over here on the right, I'm assuming that this is theta. So Theta is your time component. That's your time decay. So, remember, options are wasting assets, which means that as you get closer to expiration, the premium, especially if that option remains out of the money, that premium is going to waste away. It's going to decay away. So your theta allows you to measure that time decay. So let's go back through this one more time. Delta is your rate of change. That's your direction. Gamma is the speed of your delta. How quickly is your delta going to move? That's what gamma tells you. Theta is your time decay. How much are you earning or paying to keep those positions open each day? And then really you've got, rho. So delta, gamma, theta, vega, and rho. So vega here isn't shown. Vega is super important. That's your volatility component. So volatility can expand, which is going to pump those premiums up to the moon. If volatility expands, then that's what you want as an option seller. You want to wait for volatility to expand so that you can sell options. If you are short options, you are short volatility, which means that if you get short an option and then volatility expands, the premium is going to also expand. It's going to become greater, leading to losses for you as the seller of that option. So you got delta, rate of change, gamma, speed of your rate of change, speed of your delta, theta, that's your time decay, vega, that's your volatility component, and rho is kind of like opportunity cost because it measures the risk-free rate of return.
Bit. If you're going to fly this trade, the Greeks are your altimeter, your airspeed indicator, your fuel gauge. Every single one tells you something critical about a different kind of risk. If you ignore them, you're flying blind, and that is how disasters happen. All right, first up is your best friend in this trade, theta. This is the profit engine. It's like a constant tailwind at your back. Every single day that ticks by, the option you sold loses a tiny bit of its value purely because of time decay. As a seller, you're profiting from the steady, relentless march of the clock.
Right?
Next, we've got
So
delta.
let me
A
just
seller,
back that up
you're
real quick. Okay, so this is really important to understand. If someone goes out and buys calls or buys puts, then they are not earning theta. They don't have positive theta. They've got negative theta. When you buy premium, you've got negative theta. What that means is you are every single day paying to keep that position open, especially if that position is out of the money. So just understand that, when you buy out of the money calls, or you buy at the money calls, or you buy at the money puts or out of the money puts, you're buying a wasting asset. You're buying an asset that will decay against you. And so you really, really need to have a big move just to break even when you buy out of the money premium. So just keep that in mind. Theta is really, really important to measure.
profiting from the steady, relentless march of the clock. Next, we've got delta. This tells you about your directional bet. For a short call, it's a negative number. But what's really cool is that it also works as a quick and dirty probability calculator.
Right.
So a delta of negative 0.20 means there's roughly a 20% chance of the option finishing in the money, which also means there's an 80% chance it'll expire worthless.
Right. So did you get that? So that means if I sell an option with a 20 delta, if I sell a call with a 20 delta, that's an out of the money call. So we got to talk about moneyness so that you guys know what moneyness is. So at the money is a 0.5 delta. Out of the money is less than 0.5 delta. Further in the money is greater than 0.5 delta. So if I sell a 20 delta call, you immediately know that is an out of the money call and it's pretty far out of the money. So if I sell a 20 delta call, well, then I've got an 80% chance of that option that I sold expiring out of the money. So that's putting the odds in your favor. You want to become the casino, well, sell premium. Wait though, you've got to wait for implied volatility to be very high.
And that's exactly what you want. Then there's Vega. Think of this as your volatility gauge. As a premium seller, you are short Vega. And that means a sudden spike in market fear, a big jump in implied volatility is your absolute enemy.
Right.
The stock price could not move an inch. But if fear spikes, the price of the option you sold goes up and you're instantly looking at a loss.
Right. So The price does not need to move for volatility to move. Fear can creep in even without price moving all that much, especially if you're leading up to some type of binary event or some type of event risk, like earnings, for example. That's a great, way to boost Vega. But immediately after that earnings event, you'll get a volatility crush where Vega collapses after that event passes. So you get this increase in volatility leading up to the earnings announcement, which boosts premiums. It really juices all the premiums for those options. And then immediately after the report, that volatility gets crushed almost all the time. It gets crushed. And so that is going to suck the premium out of those options that you sold. So volatility is, you've got to watch event risk, really important.
And finally, we meet the villain of the story, gamma. If delta is your speed, gamma is the accelerator. It measures how fast your risk can spiral out of control. As the stock moves against you, gamma makes your losses speed up, not linearly, but exponentially.
Right. And so this becomes even more dangerous the closer that you get to expiration. So if you sell, options that are really far out of the money and really, far out in expiration cycle, like maybe several months out, let's say 60 days out, if their options are really far out of the money and they're 60 days out, you're not going to have much gamma that you're going to have to worry about. The speed of your delta isn't going to be very fast. But the closer you get to expiration and the closer those options get to at the money, the bigger your gamma is going to become. And what that means is a small move in that underlying asset will have a really big impact on your P&L, on your option. So you've really got to be careful that as you get closer to expiration, you got to close those options positions, because you don't want to get stuck in this gamma trap where you get close to expiration and then all of a sudden there's a big move out of the underlying and your option is going to just explode in your face, because gamma is not linear, it's quadratic.
For a naked call seller, there is no greater enemy than gamma. Yeah, professionals have a name for it, the gamma acceleration problem. And it's at its absolute worst in the final week or so before expiration. This is when even a small move against your position can cause your risk to change so violently. It can
Right.
turn a perfectly good trade into a complete disaster in just a few hours.
Right.
Which brings us to the nightmare scenario. This is the moment when all that theoretical risk becomes very, very real. Let's break down the anatomy of a gamma squeeze. And here's the key thing to understand, something that might surprise you. For a naked call seller, the catastrophic black swan event isn't the big market crash everyone's afraid of. It's the exact opposite, a sudden, violent, explosive rally, often driven by nothing more than the market's own internal mechanics. And this is how it happens. It's called a gamma squeeze. It starts when there's a huge flood of call buying. The market makers who sell those calls have to buy the underlying stock to hedge their position, but all that buying starts pushing the stock price up. And as the price rises, the delta on all those calls goes up, which forces the market makers to buy even more stock to stay hedged. It's this vicious feedback loop that just feeds on itself and can send a stock absolutely parabolic. And for the naked call seller who's trapped on the wrong side of this, that chain reaction leads to the two most dreaded words in trading: a margin call. That's when your broker sees your losses spiraling and forces you to close your position right at the peak of the buying frenzy, locking in absolutely catastrophic losses. But professionals don't just sit there and hope for the best. They have a pre-planned playbook for when a trade goes south. They have an escape plan, a set of defensive maneuvers ready to go. So instead of panicking, a pro will execute one of these moves. They might roll the position up to a higher strike price, basically buying themselves more room and more time.
Right. So you could do a couple of things to hedge an options position that you're naked short. Let's say that you're naked short some calls. You could, number one, roll up. So that would simply be, if you're short the 100 strike, you roll to the 110. So you roll up within that same expiration cycle. Another thing that you could do is roll out. So instead of rolling up, you just roll out in time. So you give yourself more time to be right. Remember, I learned this from Ton Solosynoff and Tony Batista: duration over direction. Another thing that you could do is you could hedge yourself. If you're short a call and you're trading, listed options, you could buy that underlying stock in order to hedge the short deltas that you've got when you sold that call. So if you, sold a call with, let's say that you sold 10 at the money calls. I don't know why you would want to do that. And maybe you sell 10 out of the money calls with a 20 delta, right? So now you've got, if they're all of them 0.2, now you've got short 2 deltas. So what you would have to do is you would have to buy a couple hundred of the underlying shares to hedge those options that you are short. That would delta hedge you. Now, if you're trading, let's say, Ethereum options like I am over on Derive, you can actually buy the futures. You can buy futures to hedge your short calls. So depending on how many futures you buy to hedge your calls, short deltas, you could actually create essentially like a synthetic short put using futures to do that. Or you could just deposit ETH as collateral on Derive in the first place and sell those calls against your collateral, and that would become basically like a covered call. That's basically what that is, a covered call, an Ethereum covered call. So pretty cool, pretty cool.
They could delta hedge by buying some of the stock to cancel out the directional risk. Or, and this is a big one, they can buy a different call option further out, which instantly caps.
Right. So that's, they're calling it a protective buy. It's referred to as spreading off. So if you're short, let's say you're short the 100 strike, that call naked, if you were to buy a further out of the money call, let's say you buy the 110, now you've spread off your risk. You have defined that risk. So you went from undefined risk, naked short the 100 strike call, to defined risk, where you are short a call spread with $10 of risk.
Their maximum loss and turns a scary naked position into a much safer defined risk spread.
Right.
And this is exactly why a lot of pros avoid using simple hard stop losses. A volatile stock can easily have a crazy temporary price spike that triggers your stop, kicks you out of the trade for a loss, and then immediately reverses.
Right.
A more sophisticated approach is to convert the trade into a spread. It caps your loss, but keeps you in the game.
Right. So duration over direction. You want to give yourself time to be right, because remember, options decay. So if you're short premium, that premium decays, allows you to buy it back at a profit, but you got to give yourself time to be right.
Okay, so let's wrap this all up. The allure of the naked call is obvious. It's a high probability way to make income from that variance risk premium. The catch, of course, is that terrifying, unlimited loss potential. Your dashboard for navigating this are the Greeks, and gamma is the danger gauge you absolutely have to watch. The ultimate disaster is that gamma squeeze we talked about, but the pros always have a defensive escape plan ready to go. Which brings us right back to our original question. Is selling naked calls a pro's tool for harvesting a reliable market edge, or is it a financial time bomb just waiting to go off? In the end, the answer probably has nothing to do with the strategy itself and everything to do with the person who's piloting the trade. Thanks for watching.
Great. I agree. Pilot is important. Alrighty. So that was a little bit about naked calls. Mike, what'd you think? What'd you think about that content? And you're muted. You're muted.
I was just passively listening because getting Don set up for the next show and making sure it's getting out to all the socials so that everyone knows he's coming on. But no, this is something that I'm actively trying to learn right now. Is all of the why am I drawing a blank? The gamma, delta, the Greeks. I'm actively trying to learn the Greek. I actually have it saved as my desktop.
Oh, you do?
Yeah, so I can.
That's so cool.
Well, because it just repetition.
Mhm.
I'm big with repetition. If you want to learn anything, you need to have repetition. It's what we talk about when you're working with wallets and working with DeFi and having a structured checklist and that muscle memory, those good habits. So that you don't end up losing $50 million. But I digress. So yeah,
Yeah, that would suck. That would really suck, man.
yeah.
Yeah,
Well, I mean, that happened to that guy the other day.
I know. It's horrible.
Yeah. So if you want to watch yesterday's show, we went into depth on it of how to avoid that, and very simple how to avoid that. That was a very, very stupid $50 million mistake. So, but back to your point is,
Was it really a mistake though? Was it really a mistake? Because there were like a half a dozen systems that all failed all at once to make that happen.
oh, well, I mean, there is some malicious, activity behind it, but the sandwich attack that you talked about and things like that. But that person's the one that clicked the button, to do the swap and that sort of thing. So
Yeah, true.
they could have avoided it. It's like a bullet coming at you, and you're freaking Superman. You can figure, woo, you got to do
Yeah,
it.
they could have. They could
Yeah.
have.
So, but to get back to your point is, once we get this show going a little bit more, I really want to get serious about, really learning, how to leverage these tools that you talk about to where I can be more successful in my DeFi positions, because I'm very, very conservative. Most of my positions are just staking and, at most a full range pool. I have like one ranged position that is the wrapped ETH USDC pool that I'm basically at a range and hodling ETH right now. But I do want, before I get into some of these advanced strategies, before I start looping and things like that, I want to thoroughly understand, the Greeks and ways to hedge and mitigate my risk and things like that. Because I mean, nothing's 100%, but if you can, if you can mitigate your exposure, directional exposure, and increase, not guarantee, but increase your chances to profit, why wouldn't you?
Yeah, so the way that I view this is as something that you really need to do your homework before you get involved in. Like
Yes.
you've got to learn the basics first before you jump in with any real money. And it's
Have we mentioned
really,
DeFi University yet?
I mean, yeah, I'm showing it right now. So remember, you guys, this content's all free. Like on DeFi, well,
No, it's not.
it's
It doesn't
not
cost anything.
it's not compensated.
Yeah. It's net it's a profit negative.
Right. It's profit negative. So at least like, the content, like you can go and consume this content at DeFi University right now. The sign up process there, there's no capital contribution
Yeah.
required.
It
you know?
costs nothing. We can't use the F.
Exactly.
We've been instructed we can't use the
Yeah,
F.
can't do that. Google don't like.
Yeah.
So basically we went through short calls. Now we've got to go through and figure out, well, how can we use short calls and short puts together to create a range based trade? That's the naked strangle. So this is really the best way to capitalize on that, volatility risk premium or variance risk premium. This is going to really generate a lot of theta for you every single day. And as long as that underlying asset remains in a particular range, well, then you can capture 25 or 30% of the premium, close the position for a profit, and then open a new strangle. So let's take a look at this. We've got 15 minutes left, and I'll do my best not to interject too many times here so that we can bring it right up to time. Here we go.
The most critical.
Let me back this up.
All right, today we're pulling back the curtain on a trading strategy straight from the professional's playbook. It's a way to profit from a fundamental bias, kind of like a glitch that's been baked into the markets for decades. We're always taught that you make money when a stock goes up, or if you're a short seller, when it goes down. But what if I told you there's a way to make money when a stock does, well, pretty much nothing, when it just stays stuck in a range? That's the bizarre but powerful idea we're going to unpack.
So the entire foundation for this thing, the whole secret sauce, it really just boils down to one simple observation about how markets work. It's all about the gap between what investors are afraid might happen and what actually ends up happening. And here's what that looks like. On the left, you've got the market's fear. We call this implied volatility, or IV. It's basically the market's collective anxiety, a guess about how wild the ride is going to be. Then on the right, you have reality, which we call realized volatility, or RV. That's the historical tape of how wild the ride actually was.
Okay, so the difference between this blue line on the bottom, that's the realized volatility of the market, and this yellow line on top, That's the implied volatility in the market. That difference here, that is your volatility risk premium or variance risk premium. That is what you want to capture by selling high implied volatility options.
Now, here's the kicker. For decades, study after study has shown that fear is almost always greater than reality. IV is consistently, predictably higher than RV. And that overestimation, well, that's our opportunity. This opportunity even has a fancy Wall Street name, the variance risk premium. But honestly, the easiest way to think about it is as an insurance premium. See, big institutions are so terrified of a market crash that they are willing to constantly overpay for options to protect their giant portfolios. So traders using this strategy are basically stepping in and playing the role of the insurance company, saying, sure, I'll sell you that protection. And then they collect that juicy premium.
So the big question is, how do pros systematically collect this insurance premium day in and day out? Well, that leads us to the star of today's show, the naked strangle. It sounds kind of intimidating, I know, but the concept is actually pretty simple. A trader sells two options at once, a call option way above the current stock price and a put option way below the current price. For doing this, they get paid cash right up front. And what's their bet? It's simply that the stock price will stay somewhere in between those two bookends until the options expire.
Right. And so you've actually got really generous break evens when you sell a naked strangle. So the break evens on the naked strangle are the premiums collected. And then you've got to think about on the put side and then on the call side. So if you sold the, 190, 100 naked strangle and you collected, $1 to do that, you've got, your break even is going to be the strike minus your premium collected on the put side, and on the call side, the strike plus the premium collected. So you've got really, really generous break evens.
Okay, now we absolutely have to talk about the risk. This is a big one. The reason it's called naked is because if you're wrong, you're totally exposed. If the stock makes a massive, unexpected move up or down, the potential losses are, and this is not an exaggeration, theoretically unlimited.
Okay, so they're only unlimited because of the naked call. The naked put does not have undefined risk because the asset can only go to zero. So, you've got defined risk on the downside, undefined risk on the upside. That gives this strategy undefined risk.
This is not a strategy for the faint of heart. Managing risk is literally the entire game.
So how on earth do you manage that kind of risk? Well, pros don't fly blind. They have a dashboard, kind of like a pilot's cockpit, with a set of real-time gauges. We call these gauges the Greeks, and they are the absolute vital signs for any options trade.
First up, you've got delta. Think of this as your speedometer. It tells you how sensitive your position is to the stock's direction. Now, the cool thing about a strangle is that when you first put it on, it's delta neutral. It has zero directional bias. It truly doesn't care if the stock wiggles up $1 or down $1, as long as it doesn't move too far too fast. Next up is gamma. And if delta is the speedometer, gamma is the accelerator. And let me tell you, gamma is the option seller's #1 enemy. It measures how quickly your directional risk can accelerate against you. As a stock gets closer to one of your price points, especially near the expiration date, gamma risk can explode and your losses can start piling up scarily fast. But now for the good news. Let's talk about your best friend in this trade, theta. This is the main reason you even do this. See, options are like melting ice cubes. They lose a little bit of their value every single day simply because time is passing. For you, the seller, theta is like a constant, gentle tailwind dripping a little bit of profit into your account every day, just for being patient. And finally, we have Vega. This one connects right back to that fear versus reality thing we started with. Vega tells you how your trade will react to changes in the market's fear gauge, that implied volatility. Since the whole premise of our trade is that fear is too high, what we want to happen is for that fear level to come crashing down after we get in. When fear drops, our profits go up. Okay, so we've got the mechanics, we understand the risks and the gauges. How do the pros actually do this day to day? Well, I can tell you it is not based on gut feelings or hot tips. It is a systematic playbook based entirely on statistical research. So let's run.
Honestly, you don't even need to look at a chart at all. You don't need the chart when you're trading this stuff. All you need is the chain. That's it.
Through the basic rules. Pros typically enter these trades around 45 days before the options expire. That's kind of the sweet spot. They pick their price points, their strikes, at levels that have roughly a 16% chance of being hit, which means they start with a high probability of profit.
Right. So let's walk through this. So you enter, so this is saying 45 days to expiration, but the Tasty Trade research from Tom Sosnoff and Tony Batista says that sweet spot is actually 56 days to expiration. Now, when you select that 16 delta call and put, what you're doing is you're selling a 1 standard deviation out of the money call and put. And when you close, either you want to open both legs at the same time, and you want to close both legs at the same time. And you don't necessarily need to shoot for 50% of max profit. What you really want to do instead is shoot for like 25 or 30% of max profit. And then you've really got to make sure, yeah, exactly, right? You really got to make sure that you close this thing out by 21 days to expiration, because you do not want to get stuck in a gamma, explosion. That would be no good.
And here's a big one. They are not greedy. They mechanically take profits once they've captured 50% of the initial money they collected. And absolutely crucially, they get out or manage the trade before the final 21 days to avoid that explosive gamma risk we talked about.
Right.
And this table just hammers that point home. It's a game of probabilities managed by strict, non-negotiable rules. Taking profits early has been shown to maximize your win rate and smooths out the ride. That 21-day rule lets you sidestep the most dangerous part of a trade's life. And that hard stop loss, that's your in case of fire, break glass circuit breaker for those rare, catastrophic market moves. Pros are also incredibly picky about which stocks they'll even consider for this. They're filtering for stocks that are super liquid, so it's easy to get in and out.
Right. So that spread needs to be very narrow. You need a super narrow spread, otherwise you can't trade. Or you've got to wait to get your price. That's been the big challenge over on Derive, is that the spreads are wide. And so that means I've got to put an order in and wait to get filled, or use request for quote. And then IV rank, this is your implied volatility. So you really need that expensive volatility, that high volatility. You need that. Otherwise, you can't sell options. You need expensive vol. And then, this beta weighted delta. So when you enter a short strangle, when you put that position on, more than likely, you're probably going to be, close to delta neutral if you're selling a 16 delta call and put. But most of the time, look, most people have some type of a market bias. Most people have some type of a directional bias. So maybe you want to sell a couple more calls than puts, or maybe you want to sell a couple more puts than calls, or maybe there's a little bit of call skew, or maybe there's put skew. All that would mean is, if there's call skew, those calls are priced higher than the equivalent out of the money puts. If there's put skew, then the puts are priced higher than the equivalent out of the money calls. So maybe if there's some call skew and you want to take advantage of that, you would sell a strangle at a ratio. So maybe you would sell like 3 to 2. You'd sell 3 calls for every 2 puts you sell, because you want to take advantage of that call skew. That could be an interesting strangle to put on.
And most importantly, they prefer to sell options when the implied volatility rank is high, which is just a fancy way of saying they want to sell when fear is already elevated and the insurance premium is expensive. You want to sell when prices are high, right? Which brings us right back to the elephant in the room, the most critical part of this whole thing, managing that big, scary concept of undefined risk. And this is the fundamental trade-off you have to understand. The naked strangle on the left gives you the highest possible premium and the widest margin for error. But in exchange, you accept that undefined risk. Now, its risk-defined cousin is the iron condor. It's basically the same trade, but you buy some cheap, far-out options that act like guardrails, capping your maximum loss. You collect less premium for sure, but you also get to sleep at night knowing exactly what your worst-case scenario is. Another key difference is the kind of account professionals use. Most retail
So this is super, super important. It's very, very difficult to trade without portfolio margin, or at least you make much less efficient use of your limited capital. So you need a portfolio margin account to really take advantage of these undefined risk strategies, although you can definitely trade these, even if you don't have portfolio margin. Now on Derive, you can create a portfolio margin account, with $100, which is amazing. You won't be able to trade anything with $100, but with $500, you could put on a position in a portfolio margin account on Derive. But if you're using like a traditional broker, portfolio margin accounts are like 125K and up, I think.
Traders operate under what's called Reg T margin, but pros often use a more sophisticated system called portfolio margin. It analyzes the total risk of your entire portfolio at once, and the bottom line is it's way more capital efficient, which often allows for more leverage.
And I really cannot overstate this point. While the probability of any one trade working out is high, that tail risk, that 1 in a million black swan event, is very, very real. A surprise overnight market crash or a bad earnings report can cause a stock to gap down so violently that the losses can wipe out not just the margin for that trade, but your entire account. It is no joke.
This is exactly why pros don't just put a trade on and hope for the best. They have a defensive playbook ready to go. If a stock starts moving against them and testing one of their price points, their first move is often to adjust the untested side, the winning side of the trade, by rolling it closer to the current price. This does two things. It collects even more premium, and it reduces their directional risk. At that point, the goal isn't about hitting a home run anymore. The goal shifts to pure survival. So this all leads us to the ultimate question, doesn't it? Is this a genuine, high-probability strategy that systematically harvests a real edge in the market? Or is it just a low-probability gamble? Like picking up pennies in front of a steamroller? And the answer, it seems, lies right here. Success with this kind of trading has very little to do with the initial setup or predicting where the market's going. It has everything to do with the disciplined, mechanical, and completely unemotional response you have when, not if, but when a trade goes against you. It's not about having a crystal ball, it's about managing the probabilities of right now.
Brilliant. Brilliant. So it's really about how do you manage your deltas when your strikes start getting tested? That's really what it comes down to. So that's why, if you trade in a portfolio margin account and you've got the ability and the capital on hand to buy stock when you need to delta hedge, or to sell futures when you need to delta hedge, or to buy futures when you need to delta hedge, if you can do those things, then you can manage your risk and give yourself duration. Because remember, these options decay. So as long as you give yourself time to be right, then you're more likely to win. Or, what you could do is you could just, if your strikes start getting tested, you can roll out in time. So you could roll those options out to the next expiration cycle. Again, just giving yourself more time to collect more theta, more time to be right. So there's all sorts of different ways to hedge yourself once you enter a position or once your strikes start getting tested. Mike, we've got 2 minutes left. What do you want to do with the last couple of minutes here?
Well, I want to just anybody that joined us during the 2-hour show, just want to quickly point out, if you are finding value in this content that we're putting out every day, Monday through Friday, 9 a.m. to 11 a.m. Pacific and noon to 2 Eastern, come on over here to YouTube and follow us at @thenode_channel. You can also follow us on X at @thenode channel. And you can also find all this content that you don't have to pay for. Not going to use the F word. Over here on thenode.pro. So you can find DeFi University with all this content that, again, you don't have to pay for, and get a DeFi education. You can watch the show live. Our newsletter is about to go live, where you can get basically an automated newsletter that for the assets, custom made for the assets that you are interested in, both traditional and crypto. Live coaching, everything you could want. And it, for the most part, like 80-90% of it is at no cost to you. So I'm going to go ahead and if you want to sign off, I'm going to start the other show. Let me do that real quick. And let's see if this live redirect is going to work.
Sweet, man. Well, I'm going to be looking at it.
Till next time, Friends in Crypto out.
Peace.